Jason Schenker is with us right now, President and Chief Economist at Prestige Economics. Jason, good morning from the Asia Pacific, sir. Thank you for taking the time to speak with us. The soft data continues to be soft. The hard data continues to hold up. Which one do I pay attention to, Jason?
Morning, David. Yeah, it's great to be here with you. I think there's a lot of really confusing data if you're trying to take it all in at once. But I think as we're looking at the Fed and we're looking at markets, the top things to think about are the jobs numbers, inflation, and GDP. And if we look at the jobs numbers, that was pretty good. The labor market's been holding up. The JOLTS numbers showed a slowing of openings last week, but there's still almost 7.2 million open jobs in the month of March. Unemployment rates low in April at 4.2. We've got a record level of U.S. non-farm payrolls right now. We have a record high labor force. That's all really positive for the labor market. And even though jobless claims went up at a little over 1.9 million for continuing claims, it's only around 1.1% of the total labor force. So the labor market looks good. On the inflation side, we saw the PCE and PCE core slow, with the year-on-year PCE up now only 2.3%, the core up 2.6%. We're moving closer to the Fed's 2%. And as you discussed in the last segment, the drop in oil prices has been significant. We're seeing some more downside risk, and that could actually open the door then for the Fed to cut rates. As for GDP, if we look last week, we did see that drop in GDP by minus 0.3%, but there was a massive pull down because imports surged in Q1. There was a big pull forward effect. U.S. companies wanted to make sure they got their imports in before the tariff announcements on April 2nd, and that really pulled down GDP. Otherwise, it would have been a really strong print, which means in Q2, because they were pulling forward, you might see imports pull back. And if imports drop a lot in Q2, the net exports number could become a positive contributor to GDP, which means Q2 GDP could still be positive. Right now, based on the Atlanta Fed GDP now, it's reflecting 1.1% would be the positive print based on currently available data for Q2. So it's actually a pretty good set of dynamics right now, although there's a lot of data to think through.
Yeah, I'm just wondering with this jobs report, does it constrain the Fed, though, to cut rates sooner? We've already seen the likes of, I believe, Goldman, Barclays. They've already pushed back their predictions of how soon the Fed could cut. They're thinking from June to now July. Jason, what's your take?
There's been a big shift. If you looked at the CME Fed Watch tool a week ago, it looked more like a 2/3 probability of a rate cut in June. It now looks more like a 1/3 probability of a rate cut in June. I think what it does is it removes the necessity to cut rates because the job market's still pretty good, and almost 70% of GDP in the U.S. is consumption, people buying stuff, and people with jobs, they buy stuff, wages keep going up. All of that is supportive of growth. So if the labor market is still at full employment, the Fed doesn't see a giant red flag, warning sign, alarm to cut rates. As for the inflation side, we're still not at the Fed's 2% target, but we could see inflation ease over the next couple of months due not only to these lower oil prices, but some year-on-year base effects. And if inflation eases a bit further, that could open the door for that June rate cut. That's our forecast. We still expect a rate cut in June, but almost no probability of a rate cut in May this week.
Jason, how do I need to be thinking about the dollar? I mean, the dollar is effectively, and this is a relative term, I'll use the word collapse because we don't normally see the dollar fall this quickly against most, if not all, of their peers. And has that loosened now policy for the Fed? And might we be sleeping on the possibility the Fed actually does not need to cut this year?
I think the dollar is really good for what the Trump administration is trying to get to, where they're shifting the U.S. economy towards a more industrialization, more manufacturing focused economy, moving more to a wartime economy to project more effective deterrence, to prevent a kinetic conflict with China over Taiwan. Weaker dollar really helps your exports, really hurts imports. That's a positive for GDP. It's positive for manufacturers. And even though the ISM manufacturing index contracted for a second consecutive month in April, it was still not too far away from the break even of 50. And some of the material handling data that we produce at Prestige Economics, the PMI, that index shows that we've seen continued positive expansions in new orders and shipments in the material handling industry, which is tied to supply chain and logistics. In other words, within the United States, there are indicators that the manufacturing and physical economy is doing quite well. And of course, a weaker dollar, very positive for that.
Jason, you mentioned something about how you think price pressures, oil prices could actually lead to inflation to start subsiding in some ways. I'm just wondering what impact would tariffs have in any way? Wouldn't that be inflationary?
Tariffs are a mixed bag because while tariffs can be inflationary, fear of tariffs can be recessionary or deflationary. It depends on what happens with the consumption dynamics. And of course, we've looked at the different categories where inflation might creep through, and there are a number of categories where it's likely to have an impact, but others that aren't. If we think about the categories that are most important for U.S. inflation indicators like shelter, it's not as critical. We think about food, well, that might not really be as significant because we're seeing China reducing some of its imports of food from the United States. And that means there may be other food products that are more available. It'll depend on the mix of products. There is a risk of more inflation later in the year. But again, that depends on what tariffs stay and what tariffs go. So it's really going to be something that is one of the uncertainty things many companies are trying to think through in the year ahead.
Jason, your wild card. What's a known unknown that could mess with your math, sir?
Biggest known unknown is that we move from the Cold War II environment that we're in right now, where the United States and China are at loggerheads, and you see those tensions accelerate, and that could be a bigger risk, where if suddenly China decides to move up the timeline for a permanent blockade of Taiwan, that becomes a material risk. We've seen those drills around Taiwan multiple times last year. We've seen different drills this year. If we see that kind of thing accelerate, if we see actual move towards kinetic conflict, that's probably the absolute biggest wild card. We go from Cold War II into a more hot war scenario.
And Jason, I got to ask you too, just where markets are right now. I mean, you look at the equity market, you look at the treasury market, it seems like nothing has happened since April. But then I look at the dollar, I look at oil prices, for example, which has been more than 15, 16% down for Brent. What are these dislocations telling you right now, especially when it comes to oil prices too?
Well, this stuff looks really good if you want to reindustrialize the U.S. economy, because you now have, with lower oil prices, probably lower inflation, greater ability to cut interest rates, a weaker dollar, which favors exports and is going to hurt imports. If I was trying to reindustrialize the U.S. economy and move it to a more wartime footing and increase manufacturing, I would want a much weaker dollar and lower interest rates. Lower oil prices help get you there, and a lowering greenback certainly helps along the way.
Right. What's your forecast on oil?
Oil prices for the balance of the year, even before today's announcement, we were expecting prices to average between $61 and $61.50 for the balance of the year. And for next year, we see it closer to $65 a barrel for the average.
Jason, always good in terms of tying it all together for us. Jason Schenker, president and chief economist at Prestige Economics. We got plenty more ahead. This is Bloomberg.